What's up, guys? It's your boy, Young Equity Chris.
And it's your boy, Young Equity Devin. Let's get it.
Okay, today we got a really important video for you. We're going to be talking to you guys about how to invest in a bear market, because right now, some think we may be in a bear market, some maybe think we're in a correction. But either way, the tips we're going to give you in this video will help you navigate both of those situations. Devin, take it off.
So when I'm in a bear market, I like to have 50% growth stocks. I like to have 15% spec plays, 20% on my cash position, 10% dividend plays, 4% for bonds, and 1% for crypto, because you can kind of get some of your money back on the crypto. Bitcoin is going to the moon right now. And also we have some Dogecoin conversations as well. What do you think, Marcel? What do you think about my asset allocation, and is that important in a bear market?
Yeah, I sort of kind of agree with that. I definitely agree that you need to be raising cash. You definitely don't want to be over leveraged in any way, because when things are coming down, they tend to come down a lot faster than they go up, right? So I think it was really great that you said that you want to keep the spec plays on the smaller end of the portfolio. Right, the growth plays, like your quality growth plays, you want to be making sure that you're nibbling at those on the way down. You never want to catch a falling knife, right? So you never want to catch it, especially at the beginning of the day. When you wake up in the morning, you see that market is all red, it's nasty. Typically that's not the time though I like to buy. I like to let the day go by and buy at the end, because typically it gets worse as the day goes on, right? So you want to make sure that you're not too hasty to buy. But I definitely like the way that you allocated that portfolio. Dividends are sort of kind of your best friend in times like this. They sort of kind of help you keep you afloat. If you take a 10% fall, but your dividend's 3%, you really only taking a 7% fall. And then you wait on that stock to sort of kind of find its bottom and to continue its uptrend. So I think that was a great allocation.
And also appreciate that. Also with bonds, you can see that the 10-year bond yield interest rates are going up. Right. I think it's around 1.6% right now, which is actually beating the inflation. So you can start getting involved with bonds again. Another thing that we like to do is dollar cost average, right? So I dollar cost average weekly. But Marcel has kind of shed some light on when you should, and it should be 6 to 8% is what you kind of.
That's sort of kind of my rule of thumb. Yeah. I typically buy in 6 to 8% price drop increments. If you sort of kind of do the math, you'll see that that's roughly trading between your 50-day and 100-day moving average, and then your 100-day to 200-day moving average. Those are sort of kind of like the rough estimates on how that falls, especially when things are in a correction and bear market. You can't really time the bottom. You can't time the market, but you want to be able to buy close to the bottom, right? So you want to make sure you catch that the very bottom of that decline, so that when things go back up, that you have a great cost average and a great cost basis to multiply those gains on the way back up. And so you don't want to buy too close together, because when you do that, you basically burn up money and you really do nothing for your cost average. It doesn't really go any lower, but now you have less cash to actually make more meaningful buys.
Okay, so essentially you would need to build your cash position, so then you can take advantage of that 6 to 8% drop. And if you wanted to wait until 24% is what you said, which is a bear market, then you can go ahead and make those purchases because you have built out that cash position. I try to take advantage of pretty much every Friday, because it's going to be a red day.
Right.
Mm-hmm. But now I'm going to start thinking about bringing the 6 to 8% to my strategy as well. What else is another topic or strategy that we could give the viewers for a bear market?
For sure, I buy low, sell high. I mean, just what you want to do. Like, you don't want to, like we said earlier, don't want to catch the falling knife. Like, you don't want to be in it was the FOMO phase, right? The fear of missing out, right? You don't want to be like, oh man, this could be a great possibility. Look, what stocks do is before they pop right back up, they'll settle, right? Mm-hmm. And so you'll sort of kind of see the movement. So even if you missed out on a couple percentage points, that's better than getting hit for another 10 percentage points on the way down, right? So if it pops 2% a day, maybe not buy it that first day. See what the trend is going to be, because what stocks tend to do is they'll fall for 3 or 4 days, right? And some people call them distribution days, right? When you have a lot of selling on declines, and what'll happen is you'll have a bounce. But then the next couple of days, you might have a continued decline, right? So you don't want to get caught there. You want to make sure that it's sort of kind of starting to trade sideways, consolidate. And usually when stocks start to consolidate, they tend to gain momentum and they tend to make their way backwards, back up. So you don't want to get caught in buying too high and and watching your money evaporate on the way down. So it's better to be okay with missing out on a little bit of the percentage points so where you can get a better cost average.
So another thing you guys could do is double down. Now, I don't advise anybody to double down, but that is something that you guys could do if you see that your one of your stock prices has declined by 50% or even 100%. So think about March 2020 and you had a very high cost basis. Well, you could double down on that stock, and then also you could ride that bad boy back up so you can kind of have a level set of your stock price. What are your thoughts on doubling down?
Yeah, so I'm a big fan. Maybe not double down. I don't double down a whole lot.
Yeah.
Like you said, big drops maybe. I did double down on Apple.
Okay.
What was that? That was the end of, like you said, end of March last year.
Mm-hmm.
I definitely doubled my position in Apple. A lot of my sort of kind of my favorite stocks, and we were talking earlier how you don't sell your winners, you sell your losers,
Yep.
and you increase your equity in your winners because those are the ones that took you this far. So long as the story is still intact, right? So I definitely believe in adding to positions, and if things do get ugly enough and you believe in it that much, double down. I don't see anything wrong with that. As long as you have the cash available, and as long as it doesn't ruin. I like to keep about 10% cash, so
Okay.
10% value of my portfolio in cash. So as long as it doesn't sort of kind of ruin those rules for me, then and I feel like it's a great opportunity on a bad day, put the money in.
Yeah, so just think about the market right now, right? So you have your recovery plays like your American Airlines or your Wells Fargo, your financial services, fintech. I definitely would try to diversify the portfolio to have some of those plays, and then also the ones that are going to grow over time, which we talked about 50% in, which are your Apples, your Googles, your FANG stocks, right? With your spec plays, I would definitely think about getting involved with the Tilrays, which is the Mary Jane industry, because as the decriminalization of Mary Jane happens, then the stock prices will definitely go up. Be cautious with Sundial. Know what you're getting involved in. It's a penny stock, but that thing could ride. It could it could tank as well. So I would definitely get involved with that. Also, like I mentioned before, Bitcoin is something to do. Elon Musk is a very heavy investor in Bitcoin. Also, a lot of institutions are getting involved with Bitcoin as well. Any advice from Chris on?
Oh, okay. For me, man, in a bear market, I just keep it simple, man. Try to build up my cash position as fast as possible. Get to about, if at all possible, 30%. So if I have some spec plays that are green that I didn't really believe in too much, I'll probably unload those, and I'll build up that 30% cash, and I'll start putting money into my longs. So these are companies that I believe in the long run. So for example, I invested in Palantir and Tesla heavy during this correction because I think that in the future those companies will take off. I think Tesla's going to go more from a car company to an energy company, and I think the data mining industry is going to be far more important than it is today, let's say 5 years in the future. With now, they might even start including things like health records because of things that we've seen that's happened with the illness. So those two companies I believe in, 30% cash, I put money in my longs. I don't sell anything red even if I don't believe in a company and it's red, it's like, man, I'm not going to wait for a bear market to sell it. Now, granted, if you got bills to pay and your money set up differently, you might have to make your own conclusions and your own decisions. But for me, in my spec plays, I don't put anything in it that I personally can't afford to lose. So I just don't sell anything. I stopped logging in after a while. I was like, I went to Apple Stocks app and I was like, all right, I want to buy Palantir. I look at the price there, then go into the app and buy. You know what I'm saying? So that's how I handled it, man. Because the worst thing you want to be is a paper hand just selling because they said everything's over. Because how many times have we heard the stock market is over and it bounced back? Every single time. 2008, 2016, .com bubble.
18 was a big deal too.
And these analysts, and this is another thing but these analysts on TV they're trying to get in on some of their favorite plays too that they missed that on, right? So they come on TV and they say a couple things where they they maybe badmouth the stock, and that's really just their way of their way of shorting the stock so they can get in at a good price. So you can't always believe a lot of these analysts on TV as well, that as well as some of these politicians, because sometimes they sort of have ulterior interests as well. So I think you need to do your own homework. It's always buying homework, not buying hold. So I think that helps.
So you said something very important. When somebody goes on TV or they put out an article and they give you the price target, you believe that is market manipulation?
It can be. And I it's sort of kind of funny. They were talking about Elon Musk. He puts out these tweets about Bitcoin, right?
Bitcoin,
and Dogecoin and these things, and they spike or they collapse, right?
Yeah.
And they get on him about market manipulation. And I was like, well, that's sort of kind of what CNBC is all day to me. I mean, because these guys are really no smarter than we are, the way I see it. I mean, because there's a lot of first-time investors that have made more money than these guys. Now, the track record isn't the same, but anybody can make money in this market if you do your due diligence. And so I feel like you gotta sort of kind of take it with a grain of salt when these guys get on TV and tell you certain things, and you don't. Sometimes they divulge their positions and sometimes they don't. So you also got to be mindful that they are trying to get in at a better price as well. So that's just like everybody else, right? Nobody wants to overpay for anything. So if they can drive the price down with a little bit of influence, I think they do that sometimes. So
makes sense.
And just something to remember, man. Great investors get happy when there's a drop in the market.
Right.
At the end of the day, I don't care. Any great investor, they get happy. The market drops, they're like, bet, it's time to buy. They're scrambling. They're running out of cash. When it's a bull market, you'll notice great investors seem to have a lot of cash, right? So that tells you a lot. And it's just, basically, it's a matter of psychology, right? Humans, we're fight or flight, right? And when the market is dropping, you can't fight, right? It's something you can really do, except sell, which is flight. So that's why people have a natural tendency to go and sell. But what I would hate is a new investor that got in the market on a whim at the top of the market, and then they're getting slaughtered in this correction. They say they hate stocks forever, and they're going to keep it in this 0.5% interest bank account where they have easy access to the money to go buy Jordans and Louis or whatever. That's an L. So it's like I'd rather lose money trying to make money than give the money away and making somebody else rich. But that's my personal opinion. I'm no financial advisor,
and I'm not an expert.
But thank you guys for checking out this video. It's Young Equity checking out. Peace.